Hey guys, welcome back to our in this channel. So in this video we are going to discuss about the primary market and secondary market. So primary market and secondary market is the uh, two branches of the securities market. If you want to study and understand about the securities market, then I made a video on securities market. If you want to watch, then link in the description and you can see the link of the video in I button. You can also watch from there. So first, the security market has been divided into two. One is primary market and secondary market. So first, what is primary market? The primary market's objective is to raise the funds from the uh, investors to company. So the company is going to raise the funds from the investors. In this, the issue of the shares or debentures or the any debts instruments or equity instruments is raise the funds from the investors by directly company to an investor. In secondary market, the objective of the secondary market is to the capital appreciation, in which the secondary markets the issued security is traded on the securities exchange from one investor to another investor, and which in return gives the sellers to the capital appreciation or the capital depreciation. Okay, so the it is the in secondary markets the securities are traded. Okay, so if you want to study or know about more about the securities market, then you can watch our previous video. As I said, link is in the description and I button. Okay, so let's start this video. So primary and secondary market. So as we discussed, the securities market is divided into two: primary market and secondary market. Okay, so just I want to make it big. Okay, yeah. So here we are with yeah. So primary market. The primary market is also called as the new issues market, where the company and institution raise funds from the public by issuing a new securities like bonds, debentures, and securities. So as we normally discuss in our videos introduction about the primary market, what is the objective of the primary market and what goes in the primary market. Okay, so as we discussed, the companies issues their share securities to raise the funds from the market. In exchange of funds, the company give their securities to the investors. Yes. Now, the primary market has two major types of issuers of the securities. That are the corporate entity, which is the mainly issues of the equity instruments and the debt instruments. So instruments. So the financial instruments are the instruments in which through which the money or income is earned, like the instruments example is like the shares, debentures, bonds are the financial instruments in which it is discussing about the uh, equity instruments and the debt instruments. So equity instruments, it has been given an example of the shares, and for debt instrument it has been given as example of the bonds and debentures. Okay, so the first issuer of the securities market is the our corporate entity, and second is the issuer is the government. So government, as we know, the government is the both central level and the state level is called as any government, central level or in state level government, or we can also say the local level government. Okay, which issues the debt securities, debt dated securities, and the treasury bills. So the government issues the bonds, debentures, debt securities, mostly treasury bills. In India, government of India issues the SGF, which is the sovereign gold bond. Okay, SGB, sovereign gold bond. Okay, so like this, the government issues to fund its state activity and to make the country's economy, state economy, local level, uh, local economy to boom. Okay, so here the type of issues made in the issues made in the primary markets. So public issue, public issue is the issued to general public or anyone subscribe to them. Okay, so public issue of the equity shares can be categorized as follows. So first, so public issue. Okay, so public issue means the any general public or anyone can subscribe the uh, whatever the securities that a company providing to the investors can subscribe or not subscribe. Okay, so here the public issue is categorized as below. So first category of the public issue is the initial public offering, which is called as the IPO. Okay, an IPO is where the first public offer of a shares is made by a company. An IPO can be in the following forms. So IPO can be follow in this two types. So first is fresh issue of shares, where new shares are issued by a company to the public investor. In this kind of issue, the funds of an investor will be goes to the company to be used for the purpose of which the issue is made. So here it is saying about the fresh issue of shares, in which these new shares are issued by the company to the public investors. Okay, so in this kind of issue, the funds of an investor will go to the company to use for the purpose of which they has been raising the funds from the market. So first category we has been discussed about in the first form of IPO, which is initial public offering. We has been discussed. Next, we are discussing our second form of, which is the offer for sale. So fresh issue of shares we has been discussed. Now we are discussing about the uh, offering for the offer for sale, where the existing shareholders, such as the promoters or an financial institution of any other persons, offering their holdings to the public. In this kind of an issue, the funds of an investor will goes to such sellers of an issuers, such such sellers of an shares, and not to the company. So the issue, a fresh issue of shares, uh, and the offer for sale is one big difference is that the issue of issue of shares, in which the fund which has been company is raised from the market will goes to the company's financing. Okay, in which the offer for sale, the shares, the funds which are raised from the market by selling the company's securities are goes to the pockets of the company's promoters, financial institution, or any other person in exchange of their securities of the companies. Okay, in which the shares. Okay, so now we discuss about the second type of public issue. Okay, so first type we has been discussed about the IPO, which is initial public offering. Next type is the following on and public offer, which is FPO, following on the public offer. It is made by an issuer company that has already done an IPO in the past, and it is making a fresh issue of securities to the public. So FPO, FPO, which is the following on public offering, in which the issuer, which is the company, is already done an IPO and listed in the stock exchange is again issuing fresh new securities for the public. Okay. Next, we are so here we has been discussed about the two categories of the public issue, which is the in the primary market, which is the first one was the IPO, which is the initial public offering, and second one was the FPO, which is the following on public offering. And we also discussed the IPOs following two forms. Okay. Now we are discussing about the pref- preferential issue. So in this mode, okay, in this mode of issue, securities are issued to identified set of investors like promoter, strategic investor, and employees, uh, etc. So the in this mode in this mode of issue, the securities are issued to identified set. Okay, identified set, it is issued to an investors like the promoters, strategic investors, employees, and etc. Okay, so now we are going to talk about the right rights issues. So and when the company gives its existing shareholders the right to subscribe to the newly issued shares, in the portion of in portion to their existing shares is called as right to issue. So in this, the company gives the existing shareholders the right to subscribe the newly issued shares in proportion to their existing shares is called as the right to issue. Okay. Next we are discussing on the um, bonus issue. So when the existing shareholders of a company are issued additional shares in portion of their existing shareholding, and without any addition to the cost, then it is called as the bonus issue. So bonus issue is when the company issues the more shares, means it just diluting the number of shares, where they assume that a company ABC is has the total market cap of $100 million. Okay, $100 million, and it has the shares of assume $1 billion. Okay, 1 billion, sorry, 1 billion shares it has, and um, 100 $100 million its market cap is. Okay, now the point is that if a if a company decided to give the 1 is to 10 bonus, so then the company not going to add the any market, the company's market cap is not increases to 100 million to the um, 1 billion. The company market cap is remain the 100 million, only its number of shares and per share value decreases. Okay, this activity is practiced to make the more investors to come in the company, and make the company's value increase, and make the share look more attractive. Okay, so next, in the order to raise the funds from the public, the company need to file the offering document. Okay, so in India, okay, to so this for an Indian viewers. Okay, so where it is the documents we need to require. Okay, so I think this is only video, here only video ends. Okay, because I am using the material of the SEBI, which is the Securities Exchange Board of India. So I am using SEBI's material booklet, because I got this material book easily access about the personal finance. So let's end this video here only. So we meet in our next video. Okay, so follow us, subscribe us to know the next video when it comes, to explore you a financial markets and to make your knowledge increase in the financial field. So my name is Lokesh Koelkar and signing off, and I hope this video finds you help. So let's meet in our next video. If you not watched our video or on the financial market, then go in description or click on the I button to watch it. Thanks for watching.